Alright, this is shaping up to be a really big week. We're moving toward the Jackson Hole meeting, and that's where the Federal Reserve is going to step up and set the tone for the markets. Fed Chair Jerome Powell will be speaking, and everyone's watching closely to figure out what he's going to say about interest rates. Now, I see three possible outcomes here. First scenario, Powell could come out hawkish. That means he shuts the door on any hope of a rate cut. He might point directly to Donald Trump's tariffs and the slow but building impact they're having on inflation. If he does that, the message is clear: no cuts, and the Fed is holding firm. Second scenario, he could actually acknowledge the weaker employment numbers we've been seeing. He might express some concern that the economy needs protection from a slowdown. That would sound a lot more dovish. But to be honest, that hasn't really been Powell's tone lately, so I'm not convinced that's where he's heading. Third scenario, he plays it safe. He says the Fed needs more data before making a move. Basically, he avoids giving us anything concrete. And that's very possible, especially for such a big event where expectations are sky high. Here's how this plays out in the market. The only thing that would make Friday a truly explosive day is if Powell hints at a pivot, if he shows a real shift toward being dovish. If that happens, the markets will rip higher. If he just repeats the "we need more data" line, the markets will probably drift through Friday as if it's any other day. Sure, there will be some volatility, but nothing earth-shattering. And if he goes hawkish, pointing to tariffs and inflation, we'll see a sell-off. Right now, though, I don't see much evidence of him changing his stance. Meanwhile, while Powell is preparing to speak at Jackson Hole, Donald Trump's team is already interviewing a list of candidates, around 10, to potentially replace him next year. Remember, Powell was originally chosen by Trump in his first term, but Trump has grown more and more frustrated with him and has made that very public. At this stage, Powell is thinking about his legacy. He's not the type to bow to political pressure. He's going to play this cautiously and carefully, and I don't see him giving in just because he's being pushed. Now, let's look at how smart money is positioning. And honestly, it's mixed. There's uncertainty, and even a little confusion. On one side, there are huge put positions being taken out on the QQQ and the Russell 2000, IWM. That tells us they're preparing for a more hawkish Fed, or at least hedging against it. On the other side, there have been massive bullish bets on Nvidia. Just yesterday, close to $23 million in Nvidia options came in. Then today, another single bet worth about $3.8 million. That $3.8 million trade was targeting Nvidia at a $280 strike price. That's basically looking for another $100 run-up. And the only way Nvidia makes that kind of move right now is if the Fed turns dovish. A dovish Fed in this AI-driven market would send Nvidia soaring fast. So you've got hedges on the broader indexes, and at the same time, you've got very bullish bets on Nvidia. That tells me traders are preparing for both possibilities. Here's the bottom line: loading up on trades right now is risky. Most experienced traders are doing two things: buying protection through puts or trimming down exposure. They'd rather reduce risk going into uncertainty than try to gamble on Powell's words. The safer play is to wait. See what Powell says, let the market digest it, and then respond. There will still be opportunity after the reaction. Looking at the S&P 500, through the SPY ETF, we're sitting at all-time highs, but we've been chopping sideways. This week we've had an inside candle. Last week we saw a push higher. The week before that, a 2% drop with a bearish engulfing candle. It's all signaling uncertainty. If you want insurance, it's not because you're under-leveraged. It's because a lot of people are over-leveraged right now. On the stock side, Nvidia remains Wall Street's favorite. People are still buying, showing no fear around the AI trade. Palantir, on the other hand, has pulled back hard, but if the Fed turns dovish, it will likely rally along with the rest of the AI names. Now let's talk retail, because this is a very different story from AI. Target reports earnings tomorrow. Retail stocks have already been beaten down for a couple of years, so they're not in the same place as growth or AI names. The big risk here is that the bears are too bearish. If Target comes out and says things are simply stable, or even slightly better than expected, the stock could pop. We just saw that with Home Depot. They missed earnings, but their guidance showed stability, and the stock went up. Target is trading around $105 right now. The upside target is around $120. I'd be surprised if earnings are so bad that it sparks a heavy sell-off. My view is the risk leans more toward a bounce higher than a crash lower. Now, zooming back to the SPY chart. On the monthly candles, we've bounced sharply from April lows and are now back at the top of the long-term trend, new all-time highs. That means we're at a high-risk spot, right up against historic resistance. Normally, this is where we see rejection and a retest of lower levels. On the weekly candles, we still have that bearish engulfing candle hanging over us, a bear zone defined around 637 down to 621. Here's what matters, so, watch those levels carefully. When Powell speaks this Friday, the market will be hanging on every word. Here's what to expect, that's it. It really is that straightforward. So, here's what I'll be watching this week. Those are the choices on the table right now. Stay sharp, manage your risk, and let's see how the market reacts. Take care, and I'll catch you in the next update.